of your money. This is our live stream, and we hope you enjoy it. This is the place to come to for knowledge about how the stock market works, the economy, how that works. What are investors looking at? What are the important numbers to look at? Upcoming dates. There's a lot going down, but what we do is we take this whole plethora of things to watch, to look at, and we boil it down to a few simple things because most of what you hear is presented as extremely important in the moment. But in actuality, there's only really a few things you have to, I think, pay attention to. So we want to help eliminate a lot of the noise and focus on what you need to focus on. So the name of the show is Be the Boss of Your Money. We want you to be the boss of your money, not your money becoming the boss of you. That is very common. And somehow we lose control of money and investing and what we're trying to do and why we're doing these things that we do to save and invest for the long term. And it becomes it becomes confusing, and then and then we start to worry, what are we doing? We've lost control, can't figure things out, can't find my way out of a bad situation. And the whole thing is solved with knowledge, not less knowledge, more knowledge. And obviously you can have too much knowledge and come up with analysis or paralysis. I like to say paralysis from over analysis, or the choice. What's the word I'm looking for? Not proximity. The something, the calamity of choice. Now, man, oh man, I'm not remembering the second. But when you have too many choices, it makes it hard to make a decision. People like to have a lot of choices, but there's a reason why everything is based on three: small, medium, or large. Mild, medium, or hot, because it's easier to think in terms of choices. And this is why most people just go with the middle choice. So, what I want to do is break down the multitude of choices that you have to make, the decisions you have to make, into the key decisions. Okay, so anyway, we're talking enough about that. Let's pull up the intro. We're going to have a good show here. And then what I want you to do is pay attention to some of the numbers we're going to talk about. There are two key numbers which I think are pretty mind blowing. And when you hear these numbers, if you've been out of the market or you've been paying attention to the naysayers who keep saying the market is going to go down a lot and everything is going to end in the economy and the market, you have reason to be upset because you have missed out on probably the greatest rally we'll ever see in our lifetime, anyone who's watching this. So let's take a look at those numbers and see if we could talk about some of those numbers going forward. And we're going to take a look at Fed meetings coming up. That's a big deal. How many more rate or how, if we can get rate cuts from the Federal Reserve this year, when could they be? We'll go over the schedule of those meetings. There's only a few left this year. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money, powered by Client First Strategy. We've been doing this a long time. We want you to learn. Mostly, though, we want you to ask your questions because your questions become the content of the show. You are the reason that I do this. If you want to ask me a question one-on-one in private, you don't want that to be something in a live stream, that's okay too. But while you're watching, if you don't mind giving us a thumbs up or a heart or a wow reaction, whatever reaction is available to you. And of course, if you're watching on YouTube, please subscribe. And that, those reactions will help spread the word to the rest of your friends and contacts and Facebook and LinkedIn and YouTube. And of course, we post recaps on all of those platforms as well as Instagram. Okay, so Instagram, I'm at InstaMitchG. Easy enough to remember, right? InstaMitchG. I don't know how I got that handle. I'm glad it's still around. We have a like out there from Glenn. Glenn, thank you very much. I really appreciate the Appreciate the support, bud. Thumbs up to you, sir. All right, so let's just do a quick recap. Then I'm going to get into those two big numbers about the market. I'll pop myself up in the corner here. So we have a Dow up almost 190 points, not quite the high it was, a little over 40,000, but hovering right there about. NASDAQ new high up to almost 17,900. That is pretty darn good there. So NASDAQ up 168 points, up almost 1%. The S&P rather is up to a new record, up 0.77%. Gold backing off. Gold's been backing off from steadily above 2,400 to not being able to hold it. And I read, things about gold. Foreign governments are buying it because they're worried about currencies and the dollar at war, so they want a place to keep their value, their currencies. But gold has been coming down. Oil has had a big pop up after going down. I still believe the trend for oil is down. We have peak oil. Peak oil usage has already passed us in the United States, but it'll pass us in the world in a couple of years, according to the International Energy Agency. And we also have peak production coming up, and production is actually growing faster than demand growth. So we'll see how that goes. But yes, we're going to have pop-ups and pop-downs in the price of oil. It's still a volatile asset class. I'm not saying it's not, but I do expect one day we'll see oil under $60 a barrel, and prices at the pump one day, $2.50, will become the new normal, not necessarily just cause for celebration. All right, and the VIX 12, a little over 12, so that's the volatility index. It's still pretty low, and the 10-year yield down to 4.28%. We were just getting up to above 4.5%. It's already back down to about 4.25%. So that's pretty low. And if it gets below 4.25%, below 4.25, people are going to start talking about seeing a 3 handle again on the 10-year Treasury. If that happens, that is tied to mortgage rates, or I should say mortgage rates are tied to that. We could see mortgage rates maybe back down to the low 6% range, would be a real boost to home buyers and those who would like to refinance who are paying 7.5% mortgage rates. So we'll see how that goes. Let's talk real quick about the inflation front. Inflation has been moderating. It went down a lot from its peak of about 10% about a year and a half, 2 years ago, but it's stuck in the 3% range, 3.25%, 3.5%, sometimes a little lower than 3%, but not getting to the Fed's desired target of 2%. But in some regards, the economy is slowing. Automobile prices are going down. Automobile inventories are going up. And lots of consumers are starting to rely more and more on credit cards. The low-end consumer is getting squeezed. That's commentary from companies like Walmart and Target. So more and more people are paying for groceries. More and more people are paying for groceries with credit cards. So there's definitely evidence of a slowdown in the economy. That's also, especially in the I don't like to say the word low end. I don't want to be talking about people like that. But in the area of consumers who are not high income earners, McDonald's, other companies have said that a lot of people are stretched. So there's a lot of misery out there between inflation and wages that have gone up, but still have not been able to keep up with inflation for many people. So I could see the economy slowing down, inflation moderating, and interest rates going down a lot more. But let's talk about when the Fed could cut rates, because Fed Governor Harker of Philadelphia and Kashkari in Minnesota, these are two central bankers of the United States. They're part of the Federal Reserve. They have both said they see maybe one rate cut at the end of the year. So let's take a look at the schedule of rate cuts. Just want to make my screen a little bigger. Let me just pop you back into the screen here. Okay, can you see this? Man, oh man, this really. And can I close this? Okay. So We just had the September, June. Okay, we just had the June meeting. A few months behind, right? Slight delay in that satellite feed, but we had the June meeting. The Fed decided to keep rates steady. The Fed funds target rate, see that up there? They're keeping it 5.25, 5.5%. And they've been doing that all year. Let's go back to all of 2024, January 31st over here. Okay. 5.25, 5.5%. They're now up to the July 31st meeting. Fed meets every 6 weeks. And it's to be determined. No one that I know of is expecting the Fed to cut rates in July. Some are talking September. Some are talking November. Here's the thing, though. When you get to July and September, you're really in, especially September, you're really into the presidential election cycle. I don't think the Fed wants to be seen as having an effect on the election. Although I do think the Fed should operate independently, they do, but I don't think they should worry about how they look politically. I don't think that's realistic, but that's just my own view. If the Fed needs to cut, it should cut. If it doesn't need to cut, it won't cut. But their target rate for inflation is 2%. So that's always the cover they have for not cutting rates. The cover they do have for cutting rates is that employment has been holding up well, but not really well. The last employment report was much stronger than expected, but there were some things in consumer confidence and other areas of the economy that we just spoke about where consumers are showing some weakness. Also, job openings are lower, and the number of people switching jobs is also going lower. So labor turnover is actually starting to go down a little bit. But if the Fed does cut once this year, and that is pretty much the expectation, we get one Fed cut this year. If we don't get a rate cut this year, then I think we get none. It's not a matter of do we get one or two. I think it's more of a matter that either we get 0 or 1. But if the Fed does cut, it could wait until the December Fed meeting. It's only a couple of months away. It'll be past the election season, so the Fed won't be seen as having an influence or a hand in influencing the vote. November 7th is also after the election, so the Fed could go in November. But if they're only going to go once, it probably pays to wait until the end of the year. So that's really the thinking. But July and September are pretty much out of the picture unless the economy drastically weakens over the very near term. I don't think anybody's really expecting that. Let's take a quick look at what these numbers are that I've been talking about. I did my queries, okay, in Google. All right, and the query is, what was the closing low of the S&P 500 in 2009? So you're going back just a little over 15 years. It was 666 in the S&P 500. So the S&P 500 is about 5,400 now. Divided by 666. Oopsie daisy. All right. That comes out to 8. So the S&P 500 in 15 years is up a little over 800%. That's a staggering number. And for all those who keep missing the market or who keep waiting for a better entry point, because even back then when we were at those lows, generational lows in 2009, there were still many people saying, no, the bottom's going to fall. It's going to go lower, even though the bottom already fell out. That was pretty obvious. It's going to go lower. It's never going to recover. We have to fix this. We have to fix that. But then you have companies that are doing everything they can to become profitable. You don't need every single company in every single sector to become super profitable and super efficient for the market to go up. You just need a handful of companies, it doesn't matter what sectors they're from, to do very well. And that's what we had with companies like Microsoft, Deere, Caterpillar. I'm throwing out names other than the large cap tech stocks that we all talk about every day, like NVIDIA and Alphabet, which is Google, and Facebook, which is now called Meta, and other companies, Microsoft, for example. So Visa is another home run. So we don't need every company in every sector to do well. We just need a couple of companies to do very well. And the other big number that I want to talk to you about. Let me take you back to the share screen. What is the closing low of the Dow Jones Industrial Average in 2009? Okay, that was 6,500. So the Dow, I'm going to use round numbers, 39,000 divided by 6,500, 6 times. So you made 6 times on your money in 15 years. Now, if the S&P grows at 10% annualized rate, it could double in 7 years. Anything for that, and it doesn't have to be the market. But 7% growth, you could see the major averages double in the next 10 years. But this is, 6 times and 8 times in 15 years. That is pretty darn good growth. I don't know if we'll ever have a growth period like that again in history. And this is why we always talk about not timing the market and always waiting for the perfect entry point. There is always going to be a better entry point when you buy a stock or an index fund. By the way, you cannot invest directly into you cannot invest directly into an index, but you could invest into a security that tracks mimics an index. There will always be a better day to buy. There will always be a lower entry point. And people ask me this all the time: should I buy this or should I buy that? If you have conviction in it and you're a long-term investor, the answer is yes. Of course, it depends on your time horizon, your risk tolerance, your financial goals. But basically, if you're interested in something and you can handle the risk and you have the time horizon for it, what are you waiting for? You're always waiting for a better entry point. And what happens is people then get a better entry point, meaning a lower price to buy, but then they say to themselves, well, it's going lower. I'll wait for a better time to buy. And then it goes back up and they say, well, I could have had it lower. So now I'm going to wait for it to go lower. And they go back and forth and back and forth, and it becomes endless procrastination. And you wind up getting computer face. You just watch the stock all day long, or the index all day long, or the fund or the ETF, whatever it is. So for all those who are always waiting for a better entry point, for those who are waiting for inflation to go down, for those who are waiting for the price of oil to go down, for those who are waiting for wages to go up, you think about all of the problems that the pundits talk about that you're waiting to see go away. In that time frame, we've always been dealing with these, but in any time frame, eventually these get resolved, or the stock market just ignores them because these just aren't really important. And the proof is in the pudding. The Dow and the S&P 500 and NASDAQ are all way, way up since their 2009 lows. The S&P and the NASDAQ are hitting record after record. The Dow Jones Industrial Average is trading just below its record all-time high. So the proof is in the pudding. Has it paid to wait for a better time to invest? The answer is no. And if the market goes down a lot in the next couple of months, we have a big correction, 10%, maybe a bear market, which is a 20% drop in the major averages from a recent high. Well, what happens after those drops? The market comes back. It always has. Individual stocks don't always recover, but the major averages have always recovered and gone on to make new highs. So there you go, folks. Those are the incredible, amazing returns of the last 15 years. And for those of you who decided to sit it out, to wait, to say it's always chronically too high, inflation is too high, whatever reason you have, you've been wrong this whole time. And if you're consistently wrong and clinging on to being wrong for 15 years straight, you're probably never going to let go of that. You're probably dug in too deep to let go of that, which is just the utmost worst of stubbornness. You're probably never going to invest. So I guess this video isn't for you. But for the rest of you, thank you for following. Thank you for asking your questions and connecting with me on social. And for many of you, thank you for your business. And we will keep doing what we do here, which is a focus on investing, emergency fund, savings for future goals, investing for long-term goals, planning, taxes, estate planning, all of the things that we talk about, paying for college, Social security, the important things that you need to be knowledgeable about in order for you to create the best potential outcome for your situation given your resources. Have a great day, and I'm so thankful for you.